Hello, my name is Lisa Rosales. I'm from Langley Memorial Hospital Foundation. Thank you so much for joining us this afternoon for a discussion on legacy planning. We're very fortunate to have a legal and financial advisor with us today to lead this important conversation for us. The reason why we chose to have this conversation is because of recent world events. Over the past few weeks, we've all been reminded that life can be very unpredictable and change can happen very quickly. And it's really important that everyone has a plan prepared to protect themselves and for the people that they love. So with us today to give his insights on this matter is Lilián Cazacu. Lilián is a notary here in Langley, and he's the owner of LC Notary. Lilián has more than 20 years of experience in the legal profession, and he's also a volunteer with our Legacy Giving Advisory Committee. So welcome, Lilián.
Thank you.
Also with us is Tyler MacLean. He's a financial advisor with G&F Financial Group, and he's experienced in estate planning. Tyler's also a volunteer with our Legacy Giving Advisory Committee. He's also a foundation board member. So thank you both for joining us today for this discussion. So before we get started, I want to just briefly update everybody on the hospital. Over the past several weeks, we've had an outpouring of love and support for the hospital. And we just want to thank the community for being so generous. Individuals and businesses have really stepped up, making really generous donations of money. There have been items like hand sanitizer and masks that have been donated, and incredible food donations and care packages for our frontline workers. We have such an amazing community, and so on behalf of the foundation, we just want to thank everybody, the entire community, for supporting us. So we're going to get right into our discussion today. We've got a lot of material to cover. And so we're going to start right off with Tyler. So Tyler, the first question today is, what exactly is a legacy plan?
Thanks, Lisa. It's a fantastic question. I get asked that quite often. First, I just really like to thank the Langley Memorial Hospital Foundation for putting this seminar on. And to any of the attendees that are on, looks like we got a good group today. It's intimate group, though. We can ask questions throughout this, engage in the topics that Lily and I speak to, and love to get you engaged through the process here as well. So a legacy plan, quite often this is something that used interchangeably with an estate plan. I quite often, sometimes I hear people think it's something larger than us, or something that, maybe as an individual, you don't feel like you have the resources to consider looking into a legacy plan, but really it's for everyone should be going through this, I think, a legacy plan or an estate plan. With a professional for their specific situation. It's really about the documenting, arranging of our affairs in a way that gives direction of the distribution of our assets so that they can pass the way we would want them to when we are no longer around, we're no longer living. It's often done through documents that Lilián would be able to prepare for you. So through like a will or through a trust, or maybe through other planning activities that people like myself, a financial planner, would be able to put together, or through an investment deal or insurance company. This would be like, joint tenancy or beneficiary designations on registered plans or insurance policies. So it's not just, one person. It can be through using accountants often as well. And it's about putting all those pieces in place. And generally the goal of the legacy plan is to find the right way for you to pass the assets to the people, the places that you care about, and who you want to receive the funds in the best way possible, usually seeking maybe tax savings, protection of assets that flow to your heirs or to the benefit, maybe causes or places that you really care about. And the main difference, sorry, Lisa.
So, but what if you don't have a lot of assets? What if you have a very simple life, maybe you don't own property, you don't have a lot of dependents? Is it really necessary to have a plan?
Great question. I don't know if life these days feels too simple. I feel today and never, life is changing so often, and simple doesn't feel like a word I hear too often. But, I think everyone should go through it. Really, it's the process of arranging our affairs. And, really, if you don't go through the process and you don't document it, I hear from people, well, it'll all sort itself out. It often will, and it usually will be helped out by the government. And not sure about anyone on this call, but the last time, last people I probably want is the government to be able to decide what happens to my assets when I'm no longer there. So we may often, like you say, Lisa, that things might feel simple because maybe I don't have a stock portfolio. I don't have, these different accounts. But we forget sometimes about our biggest assets, our home, things that, pension plans, things that may have value that we aren't considering in part of our plan. So documenting that down and having control, because once you have control, you're really at the helm. You make those decisions and you decide what your legacy will be. And I think that's the difference between an estate plan and a legacy plan. Is the legacy plan is really, how is this going to carry on past me? What is my legacy going to be after I'm no longer here?
And how about Lilián? How do you feel, how's a will fall into place in a legacy plan? How important is that in a legacy plan?
I think as Tyler said, it's the plan is, not necessarily, you need to kind of sit down, have a plan, and that's done for your entire life. But the plan is actually starting even when you start buying a house or you refinance your home. And how do you appear on title? As Tyler said, sometimes you're joint tenants, sometimes you're tenants in common. And depends on your family situation. You're a blended family or you're a second, third marriage. Like, you have to take this in consideration even before you write a will. So the will is, I normally tell my clients, the will is just a piece of the puzzle. So people can understand the puzzle that is your life, either through COVID or not. You have to involve your financial planner. You have to involve your accountant. And you have to involve your lawyer or notary who, yes, when we say estate planning or legacy planning, we're talking about 3 documents that we legally do. A will that covers you for in case of death, power of attorney that covers you for any financial legal decisions while you're still alive, and the representation agreement, which was called living will in the past, that covers you for all the medical related decisions. So the will, yes, it's a very important tool. Maybe some people say 50% or half of the job is done. But again, if you don't know the family situation, the financial situation, any type of circumstances that can make you make that will, the will might not even that useful if it's not made in a contemplation of a big picture as is financial plan and legacy or estate plan.
So once you have a will or these other legal documents you mentioned, is it just you look at it, you do it once and that's the end? Or is it something that you need to continue to change over time? How does that work?
We normally suggest people look at them every 3 to 5 years. That's a good idea to look at them. Not necessarily you need to update them 3 to 5 years, but if anything crucial happened in your life, maybe some people move along and they're not in your life anymore, beneficiaries, executors, guardians of your kids, or maybe your financial situation changes and you need, maybe you win the lottery, maybe you lose money, maybe it's bankruptcy. So I would just take that into consideration, call your legal professional, your notary, your lawyer who is in charge for that. And but little things like addresses being changed is not a big deal. So we identify clients by profession, addresses, but those change. So how we do it, normally we don't put cash gifts in there. We normally talk about the residue, although we do that sometimes, but instead of talking about the cash amounts, we say, how about we think about 100%, like 100 shares, and either you have a $1 in your account or you have $1 million or more. It's still, if that makes sense for you, it's still percentages is the same. Most likely you won't have to change it in a long time.
So 3 to 5 years is kind of the
that's kind of
think
standard.
About. Okay. So Tyler, when you're creating a legacy plan, what financial considerations should someone make?
Yeah, and a lot of considerations go into place. And I think something to Lilian's point there, connecting with all professionals that you surround yourselves with, the people in your circle, is really important. I was working with a member of our credit union not that long ago where she was drawing up her will with her lawyer and hadn't maybe realized that her beneficiary designation on her registered plans did not speak the same language of the will. So what she thought, she did great work with her lawyer, whether you do with your lawyer or your notary, can maybe be a bit unwound if you're not communicating with all parties. So to Lilian's point, 100% bringing everyone in just to make sure that we're speaking the same script when it comes to the plan. So some big financial considerations. I think of who do you want to leave the inheritance to? Do we want this to be left to a spouse and children, extended grandchildren, extended places like charities, Langley Memorial Hospital Foundation, or religious groups that we're close with? And when we think of those considerations, is there tax implications in doing so? Is there, maybe implications with people who aren't the best with handling money or don't have capacity to handle money? And how do you work with that? What do we want them to receive? Do we want them to receive, as Lilian said, cash or residue from the will? Do you want them to get pieces of registered investments? Is it going to be jewelry? Sometimes I hear cases where it's not the bank account the kids are cared about. It's the serving plate from turkey dinner that mom used to use every Thanksgiving, Christmas. And that's really what can get people at each other through an estate. And you're trying to create that cohesiveness and seamlessness when you're passing on to the next generation. When do you want to distribute these gifts? So do you want to do it all at once or gradual over a period of time? I know for my family, I've got young children, and I don't know how they're going to be with money when they hit age of a majority. So we've decided, my wife and I, to distribute over kind of 3 periods. And that's what we've decided. In some ways you can do it that are tax advantageous as well. So that's a huge consideration, Lisa. Where the documents are held. Nowadays, it's not just our statements that we can throw in a drawer and say, I leave them all in this locked drawer in my office, and that's where, dad's statements are. I know where all his banking is. But what about all the online accounts? Thinking of like Zoom access or Facebook and all those accounts that we have. So, finding out where that is, and you've communicated that to the people that you care about, or people will be taking care of this. Thinking of why you're making the gift. Is it tax savings? Is it to benefit, again, a cause that's important to you? And how you're going to give it to them. Is it going to be gifted through your will? Are you going to, I see a lot more these days, Lisa, where people are passing before their legacy plan doesn't mean that it happens when you pass away. It's actually the planning through the process. So maybe you're gifting funds through the process as well before you pass away. You're seeing family enjoy the gifts. You're seeing charities use the money before you actually have passed away. You can no longer see that the money go to use. So kind of the who, what, when, where, why, and how of what I think about.
So the goal should be to provide for loved ones. Ultimately, you want to provide for your loved ones in your planning, right? I
think sometimes it's about having a bit of a personal value proposition or a value statement of, this is what I value. I value my family. I value my community. I value these things. And knowing that is a good place to start. And then finding, how am I going to distribute this? How is this going to go from person to organization, person to person? What's the best way to do that? Yeah.
So taxes can be an issue, though, for an estate, right? Because oftentimes taxes can eat up a big part of an estate. So how can a person avoid tax burden?
So I guess maybe the place to start would be thinking of why taxes occur. So it's kind of, the second before we pass away, there's what's called a Deem Disposition. It just means that all of our assets are technically sold at market value. So that's kind of the first thing that can hit an estate. So that could be like maybe assets that have capital appreciation or they've grown in value. I'm not talking like your principal residence, but secondary properties or investment portfolios. That can be a big hit, big tax bite out of the estate. A little different if it's passing to spouses, but definitely not so if it's passing to children or other. Another big tax bite is probate. So that's that 1.4% tax that hits estates on assets that don't have a registered beneficiary or joint names. A lot of people plan their estate just to avoid probate. Sometimes that's not the best place to start. I think starting with your values is more important, and then probate's probably one of the last things. But knowing that it's there and how to address it. So some ways to, kind of consider that, Lisa, is, naming beneficiaries on registered plans. That's one of the first things we can do. We probably have maybe our spouse as our main beneficiary on our registered plans. But as soon as that spouse passes away, make sure you're making those changes to your children. Falls outside the will, falls outside the estate. Joint tenancy on property, on accounts, could be a great thing to do. It's something I talk to aging members that are credit union quite a lot, is the right thing to do. There's a lot of implications to it. So when you're doing that, talking to your financial planner, talking to your professionals, your notary, your lawyers about what those implications are very important. A great way, Lisa, near and dear to you as well, but gifting investment assets to registered charities. So you have the ability to pass non-registered assets, so investment assets that maybe have capital appreciation, thinking like a mutual fund or stock portfolio, where you can pass it to a charity, avoid the capital gains, and then you can get a tax benefit for that through the charitable tax credit. Great way to do it as well. Passing assets through a trust is another way. Sometimes gifting before the estate, because if everything hits at that one day in that year, if you think about it, we'll never know when that day is. But maybe if you could start planning that a few years before, you could ease the tax burden over a period of time. But with all these strategies, there's some really good tax savings in there and strategies that Lily and I help our members and clients work through all the time. And talking to your professionals will be the best way to start.
Lilián, do you have any thoughts around charitable giving and a legacy plan? Do you have any thoughts around how that looks, or have you had any experience with helping clients do that?
Yes, I'll just touch a little bit of what Tyler said. Tyler kind of covered the entire part. I just want to take one aspect out from that, is the adding adult kids on title. And sometimes, as I said at the beginning, how you buy your house or how you choose to put it as joint tenants or tenants in common is very important, because of you can bypass the estate and avoid probate taxes or minimize the taxes. But sometimes just having that in mind, and by just doing that on purpose for avoiding the probate, which is just 1.4% of the estate, right? And you're getting involved into capital gains, which is like 25% or more out of like whatever that amount is, sometimes it's not wise. And other things like your kids could go through divorce, or your kids can go through, like bankruptcy and stuff. So you don't want to expose your house just because you'll save 1% of the estate on that. So make sure, again, like as I said before, have your professionals involved. I know that people say, well, I heard from my neighbor or from my coworker that he did this and it worked well. Well, maybe it worked well in his case or her case, but as I normally say, adding adult kids on title might be a good idea just in 1 to 3% of the cases, right? Normally, it's not a good idea. So make sure you have a professional involved, because these family transfers are happening more and more. People are calling me even during this COVID-19 and just, I just want to get off the title. I just want to add somebody on title. So these little things don't cost much, but it's like it will cost you eventually at the end, right? Because if you don't do it, and sometimes, maybe it's a shame to say, but sometimes we legal professionals, we just do what you ask us. Normally I don't do it until I see that indeed it's a good idea for that. But I have situations where I see that it was done in the past and it was not a good idea at that time, right? So now to answer about the charity giving, we do that, but that's another shame that sometimes it's like we're busy of taking care of the family and everything. We just forget about that. It's, the client maybe give, I remember one of the charts that were showing like years ago that I was looking at, one of the big charities were sharing that those stats that about 87% of the people in Canada give to charities during life, but only 7 to 8% of people giving their wills. And it was a big discrepancy how people are so generous during life, but they don't really plan. And one of the lessons that I learned at that time, that they blamed us, the legal professional, that sometimes we don't ask, just by asking sometimes. And I will take that blame. Sometimes we're busy in planning and everything. We just forget to say, hey, would you like to give something to your local, local charity that you normally suggest, a gift maybe in we call it common accident. So yes, you can give it to your spouse and then to your children, but if something happens to everybody, normally people don't have a problem adding their charitable organization, even for 10%, or they give it to their church 10%, whatever they give during life, and they don't have a problem with that giving to another charity or to including that church or including anybody. And it's good to say that it's sometimes even it's a good taxable taxable strategy, because if you have a lot of money, as Tyler said, when you die, you don't know if, all the estate is kind of deemed disposed as of the day of your death. Then you think you don't have a lot of money, but when you put your house and everything there, like 40-something% of that will be a lot of money. So if you have a 10% given to the charity, in any form, as a investment or as a just cash or property, that will lower your taxable bill, and at the end of the day, your beneficiary might get almost the same amount or maybe even more. So.
Right. Here at the foundation, we've been very fortunate to have donors who left gifts in their will. We've been able to do some really great work in the hospital with that. And we also tell donors who are interested in making a gift that they can make it meaningful. They can choose to support an area of the hospital that they maybe receive good care in. So there's a lot to be done, I think, with the charitable giving and in a legacy plan. There's a lot of options there. So we're still working on physical distancing here in BC. If you don't have a will yet and you don't have an estate plan, what can you do today from home to get going on that?
Send us an email. Yes, we normally meet people twice. We meet people for the first meeting to discuss and plan and everything. And then after we draft, after we send some homework, if people still have to send us some addresses, names, then we meet them second time. Now, we have cut the first meeting from our strategy, so everything is received by email. We have a link to our questionnaire. People fill it up, and then we have a phone conversation where some people that are like you guys today, able to be on a Zoom. I've done some of these too, because there's not much confidential information, even if Zoom, they say there's some concerns about the privacy and everything. Is just a discussion about something that you want to happen. So no SIN numbers are being exchanged, no IDs and everything like that. So we are pretty confident, but most people are a little bit older, so they prefer over the phone, which is fine too. So after that is done, we basically draft it and have people review them, and then they come in. Unfortunately, they still have to come in. The legislation is still not changed. You still have to have 2 witnesses, and we've got some nice plexiglass in our office, in our big boardroom, that we try to keep the 6 feet apart, and still is happening. So we still have plenty of clients that are okay with that. Nervous about distancing, but after we explain them over the phone, we send them a form that they have to read it and make sure that they don't have any symptoms and they haven't traveled, although nobody have, I think, traveled in the last 2-3 weeks anyways. But I think just to make everybody feel at home, and unfortunately, not unfortunately, but we are part of the essential services, and we have to be there and for people in their situations and for their essential needs that they have during this COVID thing.
And Lisa as well, on the financial planning side for creating legacy plans, retirement plans, still doing that very actively on our side as well, and really utilizing Zoom and Skype and FaceTime, or as Lilian said, sometimes phone calls if it's more appropriate. Can email and phone call and go through it. So the conversations are still being had. So if you are dealing with a financial institution, credit union, bank, advisors, financial advisors, planners are doing that, I'm sure, as I am, and making sure that we're sometimes it's more top of mind now than ever. So I think it's a very important time to be going through it, and we are trying not to skip a beat.
That's great. I really thank you for your comments. That's really great. Now we're going to turn to the audience, because the audience has sent in some really great questions during our discussion. So the first question is, what happens to my Tfsa, RSP, or RIF when I die?
Yeah, Lilian, do you want to take that question?
I'll take that, and I think you might have something else. I'll just say from my perspective, it's very important to have a good financial planner. Like I'll kind of like pump tires into Tyler's profession, because it's, RSP is a great product. However, if you don't deal it properly, and especially when you get older and you keep too much in it. I know that government has some rules about penalties, so to keep you kind of do that thing. But sometimes, some financial planners, it's, they're not on top of things, or maybe they forget, or maybe, and then people die with a lot of RSPs in there, and half of that, most of it, most of the people are in that category of that bracket that it's almost half goes into taxes, and people think they are giving that much. And it's important to say that the state pays the taxes. That's a little bit counterintuitive. The beneficiary still gets the gift, but the estate pays the taxes. But the biggest thing that you have to remember is that this bypasses the estate. So the good part of it, if you want to give a gift a little bit to a son or daughter who takes care of you more, in the will it's kind of hard because the will variation legislation doesn't allow that. So if you're a kid or a spouse and you have been given, the wording is a little bit kind of like very technical, but if I explain this in a plain English, if you have been given something that you feel it's unfair, or and you're a spouse or a kid, you have the right to challenge the will, which kind of shocks a lot of people, right? So the good part of RSP and Tfsa that, if you want to give a little bit more, make the will as equal or as fair as possible. And if you want to give a little bit more, RSP, life insurance, title, Tfsa are great products to balance those needs, because as somebody said once, fair is not always equal, right? So what's fair in your mind might be a little bit different than maybe somebody is disabled, or maybe somebody is a business owner and he's like independent and he's doing great, and somebody maybe is an addict, or he's dealing with some medical things, and you have to balance those. Who needs more? Who needs less? And it's good to have these products, that this will help. It's a great help for the estate. Even if you have a lot of investments tied up in some other investments and you don't want to open them up and just have maybe a little life insurance or Tfsa covering for your funeral and other things. So that's another tool to use. So I'll give it to Tyler to see if he can put more wisdom there.
No, that great insights, Lilian. And it just, on the tax component of it, knowing that our tax-free savings accounts, RSPs and RIFs, if it's a named spouse as the beneficiary, there is, it's a sheltered rollover, a spousal rollover in those plans. So a tax-free savings account goes tax-free. So your $60,000 tax-free savings account each now becomes $120,000 for the surviving spouse. The RSP or RIF, the spousal rollover, call it tax deferred rollover because it's not tax free. It is tax free at the event, but when you take that money out, it's still taxable. To Lilian's point, it's something that we don't see enough in our industry. I encourage all clients and members that I work with to find a definitive date to unravel those plans that is usually much sooner than we think we might pass away. We'll never know what that is, but not to just take the minimum until they're 100. It often doesn't make sense. I was sitting down with a member about a year ago who had lost his mom, and he said, "There's $250,000 left in her RIF. How do we deal with this? How can we avoid the taxes payable?" And I said, well, that conversation actually should have started about 15, 20 years ago. Really nothing you can do at that point. So knowing what the tax implication is, as Lilian said, it's all introduced into income. When you pass away, that's the RIF, the RSP. If there is children that are left on there, knowing what that tax implication is and seeing how you can mitigate that as much as possible. So those are, great ways to, as Lilian said, pass assets outside of the will, but knowing the impact and how quickly you unravel it, I think is something that is really important to investigate for your own situation.
Could a charity be named as a beneficiary of an RSP or a RIF or TFSA?
Mm-hmm. Yeah, it can, absolutely. Yeah. So you can name a charity as the beneficiary, and absolutely it's a way that the assets can go directly to the charity. You have securities, mutual funds, whatever it is. They receive the investments as is. Tax credit is then deemed to the estate, and you get a big offsetting tax credit. So someone, was talking to you some time ago, had a sizable amount in their RSPs, and they were looking to flow that through to a charity, and it was the offsetting tax entry in that for the charitable tax credit made it so it was really a non-tax event for their estate. So some great planning that can be held there.
Great. Okay. The next question we have is, who should be the executor of my estate? And can that person live out of province or even out of the country?
Maybe I'll take that. So an executor, as you know, is it's also called a trustee. So for obvious reason, you have to trust that person, and that person will hold all the money, all the possessions in trust until everything is the probate grant is given and can be distributed. So make sure it's the right person. We normally give these descriptions. Obviously, you have to trust them. Secondly, hopefully to be local, because you have to do a lot of running around and manage a lot of things. Make sure they have the time and availability to do it, because sometimes maybe in your mind that person feels that is the right person to do it, but and maybe even she or he thinks that they'll do it, but make sure they read a little bit about this position and what entails, because lately I found that a lot of people refuse to do it when the time comes, because in theory it sounds good and it sounds like not a big deal, and when they realize that an estate can take between 2 and 3 years to manage and administer, especially with like all the CRA go back and forth and the clearances, certificates, then people are not very comfortable doing it. So think about having sometimes a professional like an accountant, or even as lawyer or notary or a bank that can be a trustee. If you want to appoint them as on the bottom of the list, still appoint your spouse, maybe a brother, sister, an adult child, but then maybe have a professional just in case, so it doesn't have to go to public guardian and trustee being involved. Now to about being appointing somebody outside of the country. Normally not a good idea, because they would have to bring a bond into the court to make sure that they don't run of the money. And running of the money, if you're in Canada, it's easier because they can, it's a little bit easier to get a hold of those people. If it's outside of the country, then normally they have to bring, from my experience, it's been $25,000 or up to $50,000 or more a bond. Even for wealthy people, $50,000 out of nowhere to just put them to sit in a bond for 2-3 years, not a good idea. So most people just say no. So it's okay to come in and help the first week, 2, maybe a month, when your dad or mom dies. But I don't think anybody has time to do that outside of the country, even if they have a bond. Out of the province, it's a little bit easier, but still is the logistics of, are you really able to do that? I know that, we have banks across the provinces, and you can just do things from those provinces. But if it's a credit union, it's a local one, where you have to run other things. It's not impossible, but, and I have seen people doing it, but it's just, if you don't have another option, and that's your kids, and one is in Toronto, one in Quebec, or Saskatchewan, sure, that's okay. But again, I would strongly encourage to have a professional, like, I don't know, Tyler, you can say financial planners can be. I think you have something against that, some rules or something, but your bank can be, right? So your credit union can be one of those.
Yeah, my understanding, and I never have been or hope to be, is that a financial planner could be an executor for a client. There's big restrictions around it, but yeah, for our case, like we would use, to Lilian's point, we use professionals like trust companies that might be able to step in if someone had like a child in Washington. They might rather have a trustee, so there's no adverse effects of taxes, or like Lilian said, filing a bond to make it so they could manage the estate. And I think another point I might add on, that it's often we think maybe we'll just make the eldest child the executor, and thinking that you're bestowing some sort of gift to them. But often it's more of no, I wouldn't want to say a burden, but it's a challenging event. So you're dealing with emotions, now you're dealing with finances. So, never to be afraid to maybe look to someone that, a professional or to a friend, often someone younger than yourself, is always beneficial too. And someone that will really follow your wishes and can communicate well with your family. If it's someone that's, or the one child that doesn't talk to the other three siblings, probably not the best person who's going to be communicating and handing money out to family. And that's, great times to adjust your will, because family dynamics change often, and especially when wills get involved and money gets involved. So sometimes if you see signs like that, it could be a good time to adjust the will and say, maybe it's not family who's going to do this. It's going to be my neighbor's kid who has a degree in law, and that would be just fine.
I always advise to maybe think about saying in the will how much you give, like as a conditional gift. If they do the executorship, there's like money put aside just for that, because most of the people, just because they're close family, they normally don't want to take the money. But if they don't take the money, they feel bad because they do all this work, and and still like would like to be compensated for that. It's good to know that it's up to 5%. That's the fee that by law is allowed. So either you're a bank or a credit union or a trust company or a notary or a lawyer or even a friend or even your spouse or a kid. If one of the kids is doing it, they have the right to get up to 5%. Now, if that will be 5% is actually makes sense in some situations or not, that can be challenged. But again, when you appoint a professional or a trust company or even us, like we normally have an agreement that we say we'll charge about 3 or 3.5 or something. So we might be actually cheaper than your cousin who might charge 5%, right?
Right.
So when you choose the executor, like, not necessarily that it will cost you more, because there's a plateau how much they can charge. And if you can have an agreement or you put it in the will, just to make sure that you know how much they'll charge. So I joke with my clients. So now that we signed this agreement, I cannot change my mind and charge you 5% later on. So
Right.
you can have peace of mind that I'll treat your family right. So yeah.
I've got a few more questions here I'd like to include here. So
Sure.
Next question is, do I need to discuss my will or estate plan with my family? I think we've kind of touched on that a bit before, but is it necessary to really have that conversation with your family?
It's not necessary, but might be a good idea. In some situation, maybe not a good idea. So I would say just know the limits, play within it, right? So know your family and know what that could create. But maybe Tyler can have another perspective.
No, I absolutely, Lilian. I think, and I facilitated those meetings with families before where we have those conversations. I try to encourage people to. It's individually, it may be more of a taboo topic to discuss. But if you can break those barriers, sometimes it can also help that your executor with part of the burden, because if siblings have a really misconstrued idea of what they might be receiving through an estate, they might think that the executor is shortchanging them because they knew that mom and dad had these maybe assets that they thought they had. Maybe those were disposed of a long time ago. So having those conversations, I think, in the open is better. So there's transparency. It's easier for the executor. So I think that there can be value. And I think also the things like I talked about mom's turkey platter, things that are like the intangibles, like if you aren't documenting how you would like to be treated after death, will you be buried, will you be cremated, making sure that those conversations are being had, because the last thing you want to hear is that mom wanted this, no, mom wanted this, what do we do? And those situations can arise. So I think documenting it, if you aren't communicating with the family, maybe even attaching a will is legal in sense, not a ton of emotion. So if you have something you can draft up with it that does have some emotion around why you've made decisions, it can be helpful too. And, even itemizing things that I wanted this to go to this person that are outside of the will or some of your last wishes. Yeah.
We have a template that we give our clients. So for free, they basically type it by themselves, sign it, keep it with the will. It's called Letter of Wishes. And they can go more, in details of like the stuff that you don't want to put in the will. But as Tyler said, the biggest thing is maybe avoid the surprise. People think the surprise is good in this case. Most of the time, 99%, it's not a good idea. I have just a client this week, and he's like, "Oh, I just want them to surprise them." I say, like, if you want to open up for litigation, or even not litigation, but just creating more strain in the family that is already dealing with grief and everything, maybe not a good idea to keep surprises for this time that family is going through.
Next question is, I'm in a blended family. Are my stepchildren entitled to my estate?
Do you want me, Tyler, to take that too?
Yeah, please.
Yeah, so blended family, so even at the, like in our legal profession, that's normally even when we have seminars and presentations, that's a whole total separate, topic, and it's like very complex. Some lawyers, notaries even charge much more for those type of scenarios because it's so much more involved, and the risk of being challenged is, I would say, double as much or even triple like as a regular one. I'll explain because I don't want to go in details, but just remember what I said at the beginning. The will variation legislation says that you can, why it's called variation, because you can vary a will, so you can change a will. I know that we believe that we have the right to do whatever we want with the estate. Not really. So if you have, again, two categories are children and spouses. So when you said the question, you said stepchildren. So let's take, Tyler and Lisa, right? So they're blended family, let's say, right? So you can see their faces easier to imagine. So if Tyler has two kids, Lisa has two kids, then in Tyler's will, he doesn't have an obligation to Lisa's kids. But he has an obligation to both Lisa and his kids, right? So, and those interests might be conflicting because, if I give everything to my kids, Tyler can think, that's my need. Lisa, we married late in life. She has some. We keep the finances maybe separately. Depends whatever is happening. So maybe we're the other way around. My kids are adults and they have their own lives. Maybe Lisa is, maybe will retire, like let's say you're in your 60s, late 60s, maybe you are already retired. There's no other source of income. So all of this, what I'm talking about, the customization and why people say, well, I'll just go on at Staples and just make a kit and make a will and that would be good enough. These are kind of implications what makes your will. And it doesn't matter, like it's important if you go to a notary with experience, a notary who haven't done that before, or a lawyer, because this is the time when your will either break or make a relationship, or it will even go to litigation, because you don't have the right, you don't have the obligation to your stepchildren. But again, part of our estate planning or legacy planning is to sit down and see how we can do it, that we make it as bulletproof as possible. Bulletproof is a strong word, but again, as bulletproof as possible for litigation, for any, because, if it's not happening and people will be upset, guess what? At some point, lawyers will get involved, and hopefully you'll have enough money to pay them all, including the lawyers, and we'll still have something left over. But that's the blended family. That's another example of why you need professionals and those who understand those complex intricacies.
Okay. So we have one last question here. How can I avoid probate?
Yeah, I can start with this one, Lilián. So some of those ways that I talked about in the tax planning measures is a way to do that. So registered assets, having named beneficiaries, leaving assets that you may have single, going into joint names. Those are easy ways to do that. Trusts, using trusts is another way. But I often say, like as Lilián mentioned before, 1.4%. Knowing what that is, $14,000 on $1 million estate, I will often tell clients and members that I work with think of it like an insurance policy. You're prepaying a bit of an insurance policy that your assets remain in your name. They're not jeopardized by litigation, divorces, anything that could jeopardize your money while you are living. Pay the probate. It's not the end of the world. If you are in your last months of life, and we know that, maybe there's some moves that you can make when your kids are married, businesses, they're retired, everything is a lot more in a stable footing. Hey, maybe that's a great time to be looking at these final measures. I just often find people do it too early, Lisa. Like they will start having this conversation when they retire. So they're in their early 60s, mid 60s, early 70s, and they're saying, I think I'm going to do this because my parents did this for us, and that's how we just received this inheritance. But they're not thinking, well, let's advance now 25 years to your parents' position. That's when you should be thinking about this. You are about a generation too, a couple decades too early to probably be making that decision. And worst case scenario, if you didn't make those steps, here is the consequence. So I love mapping that out for people, like showing them, okay, this is what would happen if you did those steps you're looking to take. And I show them, here's the flaws and the red flags that could come up. And here's just what would happen if you did nothing. If you just kept it in your ownership, this is what happened. This is the actual bill at the end. How does that sound? And they're like, well, that's pretty small dollar cost to have the peace of mind that things will remain in your control. And I think that's what we all want during our later years in life, is control of our finances until we can't have control anymore. And then that's where other people can step in and help us out through powers of attorney. But yeah, I think it's those ways can avoid probate, but sometimes that journey to avoiding probate can put a lot of pitfalls along the way.
Lilián, do you have any comments on probate?
Yeah, so I'll just say that, you have to remember that, these are the three, like Tyler mentioned them, but I'll just want to recap so it's easier, because sometimes this could be a lot of information. So if you can appoint beneficiaries, do that. So, but not all the financial products you can do that. So RRSP, you can do that. Tfsa, you can do that. Life insurance, you can do that. Bank accounts. And we're talking now for, as Tyler said, about if your spouse is gone already and you're in your, let's say last 5 years of your life, not necessarily that we always know that, but if you kind of feel that you know what's happening, then sometimes people appoint co-owners on the bank accounts as well. So if you're co-owning something, the house is different. I'll just say in a minute why, but bank account together or any investments together, and RSP, TFSA, that's a beneficiary. And then the only thing you're talking about the house, but the house is the most litigious part, because it's like sometimes, first of all, the people still have to understand the joint tenancy. We use that, a lot, but just you have to remember, if it's joint tenant, it talks about the right of survivorship. So if your wife check your title search, maybe you bought your house 5-10 years ago, find your notary documents. Last document that you got from the notary should be a title search or a state of title certificate. Look under your names. If it doesn't say anything, it's tenants in common. If you're blended family, maybe that's what you want, but it should say joint tenants most of the time. That means, if Tyler is in the same marriage, they have kids from the same spouses, that's what you normally want to see. Because if something happens to Tyler, it goes to his wife automatically, and vice versa. No probate for that. It's just you need to come to a notary. We can just get the deceased person from the title, take him away and just leave. It's an easy transfer of the property. However, when we talk about the adding kids or adults kids on title, talk to your professional again, because that in your mind might be one of good solutions to avoid probate, but you have to make sure it works for your specific case.
Right, okay. So we're going to start to wrap up the conversation now. So Tyler and Lilián, any last words of advice or comments do you like to make on legacy planning and estate planning?
I could just, well, first of all, thanks again for putting this call on. It's great getting this information out. And we're here as the legacy giving committee, planning committee, to answer any questions that anyone has anytime. I just don't think it's ever too early or late to start the plan. Stats are high. Over 50% of Canadians do not have a signed will. So having the conversation and just starting it with someone, even if it's family or friends, having the conversation, and then bring all that information together to professionals that deal with these cases all the time, because they can likely outline things that maybe we won't see coming, but we've seen it happen in the past, and we can use our insights. So just thank you again for attending.
And I would also thank you guys for hopefully listening. I see that there are some people there, and hopefully there was something good that we said that maybe stuck with you. You know, just to remember, it's when you say plan, it just doesn't sound like a very complex thing that we have to get your old taxes and, you know, we have to bring a big binder. We start very simple, and maybe you'll have some homework. We'll need something from you, but most likely not. So don't be afraid of that big legacy plan, big words, but you just don't do nothing. That's the biggest problem, right? So honestly, even when you don't do nothing, you're still planning. Even when you're, as I said, when you're buying a property where you're registered joint tenants or tenants in common, where you make some investment or beneficiary designations, that you're already planning when you do that. So just make sure, you know, you have the professionals, the right professionals that advise you along the way. So these things together make a good, sound plan that you know, eventually will work for saving taxes, saving relationships, and saving money in the long run. That's kind of my motto lately when I do that, because if you do that, then if you keep the family together and there's no litigation at the end of the day, and everybody actually, I had situation when people start speaking to each other after the death of their mom or dad because it was a good plan in place, and in that case I was kind of the executor, so I had to be the mediator between them, and it was great. Like I that's what I feel. I feel good about yourself when actually the plan worked out and everybody's happy at the end of the day.
Well, thank you both for taking the time to share your expertise with us, and thank you to our audience for taking the time to learn more about legacy planning. Even though the discussion right now is coming to an end, it doesn't have to stop. We're going to follow up with everybody. We're going to provide a link to this some discussion today, and we're going to share some resources and also the contact information for Tyler and Lilian if you decide you need the help of a professional. So we also want to thank you again for supporting the hospital, and on behalf of the foundation, thank you for attending, and we look forward to future discussions about legacy planning. So everyone have a great day.
Thank you, Lisa. Thank you, Tyler. Thank you, Tyler.
Yeah, thanks. Sorry, just
hosting.
of course. Yeah, just I think there's one more person maybe still left on the call here. Nancy, are you on the call here? Did you have any questions here? Or? That's interesting. Yeah, no, thank you, Lilian. You did a great job. I wasn't sure if Lisa was going to stay on and connect with any thoughts, but I'll stop the call here. Okay, now it's just the two of us. Sorry, someone was on there for quite a
while. I understand that. So was it recorded? So
yeah, it's actually.